following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady. And I know tax season ended last week, but it's the beginning of the new beginning, and we certainly want to keep you informed. So I'm Esther Gulius, the Tax Lady from EG Tax. I'm going to tell you, as everything unfolds out of Washington, you can get it first here on News Radio WBEN. And I'm joined in studio with Tiffany Fabian. Hey, Tiff.
Hey there, Esther. How are you doing?
I'm good. And Christopher.
Hello, Esther.
He'd be Fabian as well. They're the dynamic duo. We're going to talk today about some of the things that you heard this week or didn't hear and how it would affect you and things that are coming down the pike. And so if you have questions, as best as we can answer them, we certainly would want to hear what you have to say. 803-0930, 803-0930, star 930 on a cell phone. And, of course, we want to talk about the proposed tax law changes, and everybody's very apprehensive about that. But before we get into that, Tiff, what kind of things are we looking at right now at corporate? What are we seeing coming down the pike?
We have people call all day long. I filed my New York State return several months ago, and I still don't have my money. So if you call, we're kind enough, and we look up their filing status and their amount of their refund, and we go on New York State's website, and you punch in their social, their filing status, the refund amount, and it says, we have your return. We're processing it. No other information is available at this time. So New York State is very slow to get refunds out. I even think slower than in years past. We're also seeing people who are receiving letters from the IRS, Internal Revenue Service, because they didn't file their 1095A.
Explain what that would be. What's a 1095A form?
That means that you went and you obtained health insurance through the marketplace. And so if you obtained health insurance through the marketplace, you now have to allocate a portion and make sure that the amount of stipend that you got subsidy right? was too much or too little.
Not everybody that got health insurance through the marketplace gets a 1095A, though.
Correct.
Right. Some people got full Medicaid.
That's right.
And they didn't get a 1095A. But if you had a subsidy, then you would get the 1095A form, and that's what you have to reconcile.
That's exactly right. That's right.
And so you do it after the fact. And what they do is they hold up your refund pending the reconciliation between what they subsidized, what you said you were going to make, and what the actual subsidy is and what it should have been. And they're reconciling that against your tax return.
Yeah, that's right. Like I had a young man that used one of our offices, and he said, I got health insurance through UPS. And so he says, well, I don't have to fill out anything related to a 1095A. But the truth is, before he got his job at UPS, he was getting it through the marketplace. First. And so he received a letter. He thought just because it was a few months, it was something he didn't have to worry about.
Right. And that subsidy, if you, at the time that you filled out the application for New York State, and by the way, this is relevant right now, right? I mean, people are filling out applications in the New York State marketplace right now and saying, I don't have any income, or I just lost my job, and as a result, they're going to give you a subsidy. But then 3 months later, you might get a job.
That's right.
So what you said was the case 4 months ago is not necessarily the case in the future. You got to let them know so they stop the subsidy. Now, the subsidy feels really good when you're getting the subsidy, but it does not feel real good when you file your tax return.
That's exactly right.
Right?
That's exactly right.
Yep.
All right, so we're getting those kind of anything else, Chris, that you can see?
Just if you get letters, don't pay it. Bring it in, mail it in, fax it in, even if you don't use us, have some tax professional take a look at it, because you hear us say all the time during the summer, at least 70 to 80% of these letters are wrong.
Right, because they're getting partial information. And so based upon the information that they get, they send you a bill.
That's exactly
Yep.
right. I've had a
Okay.
few letters this week also from people who didn't put their stock sales on too. They have to do a 1095. They got a 1095B and they didn't include it on their tax return. 1099B.
Oh, I was going to say a 1095B is different than a 1095.
A 1099B.
Yeah, right, which is sale of stock,
Correct.
right? Well, why don't we go first to the phones? I think we have who?
We have Fred from
Fred.
Eden.
Right. Hey, Fred, this is Esther Gillius. How can we help you, sir?
Yes, Esther. I turned 70 in December,
Aha.
and I have a 403B
Uh-huh.
taxable annuity.
Uh-huh.
And when am I supposed to change that to either to annuitize it or to take my RMD?
All right, so Chris and Tiff, he's saying he's going to be 70 and a half this year. When does he have to start taking his RMD?
Well, truth be told, you don't have to start taking it out to April 1st till next year. But if you wait that
Doesn't
long,
have to,
you don't,
right?
Right. You don't have to take it out this year. You could wait to April 1st next year. But if you do that, then you have to take out 2 distributions in 2018. But this is where you got to do tax planning and see what's better for you. It's just take it now or to wait next year, depending on your income.
Here, let's put it another way. You can take it out this year, but the first year, in the year that you turn 70 and a half, they say, well, you can take it out that first year, or if you want to push it off till next tax time, you can double dip next year in 2018. Take the first distribution before April, take a second one after April. And then, so you, like what Chris was saying, you'll end up with 2 distributions in 2018 rather than 1 in 2017. And the best thing to do is to tax plan for that to see how it would affect you. Now, looking at, it looks like there may be some tax rate deductions, reductions. It may be in his best interest to maybe wait till 2018, seeing how things wait. And he has till December the 31st to make this decision, right?
That's right. Yeah, we don't know how fast Congress is going to act on these proposed changes, how they're going to come into play, what are they going to change, how the whole picture's looking even. We don't even know that.
But let's say right now he's in the 25% bracket, and let's say his bracket's going to drop to 15. He would actually save 10% by waiting till next year. And he has till December the 31st to make that decision, so he can kind of sit tight and wait and see what happens with the proposed tax law changes.
That's right.
The-
That's really wise.
Can I ask an alternative question?
Sure.
Now, if this is a 403B flexible annuity, is it my best interest to annuitize that, or?
Well, I mean, when you do the required minimum distribution, in effect, you are annuitizing it, because if you're going to take out the minimum, all right, then what you're going to do is your divisor is going to be basically based upon your life expectancy. And Tiff or Chris, you know what the divisor is the first year?
27.4.
Right. So you would divide whatever the 403B is by 27.4. That is going to be the amount that you have to take out to comply with the minimum distribution. And that's what you're doing anyway. But you are free to take out more. They would love you to take out more.
Can you transfer that 403B?
Well, you can, provided that there's no problem, you can roll it over into an IRA. But why would you? It's the same. It's going to be the same answer.
I retired now. I'm disabled.
But it has no difference. It's still going to be taxed the same way.
This is in one place instead of spread out a little bit here, a little bit there.
Well, you can roll it all over. You roll it into one IRA if that's what you want. I think the next thing you have to do is look at the kind of return you're getting in your 403B. Because if the state of New York managing your 403B is better than you can get putting it anyplace else, you might not want to move that, you know?
But you can't move it.
As long as there's no objection, it's a qualified pension plan, so you should be able to roll it over into an IRA. Okay?
Okay.
All right.
Thank you very much.
All right, Mr. Goulias, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on a cell phone. We're going to take a short break. We'll be back talking about the tax law changes, how they affect you, and your phone calls after the break. Hey, I'm Esther Goulias, the tax lady from EG Tax, and taxes were all over the news this week, and we are doing the very best we can to keep you up to date so you know how the proposed tax law changes are affecting you. And again, if you have any questions, 803-0930, 803-0930, star 930 on your cell phone. Let's go to the first thing I'd like to tell people is right now, thinking about taxes, you want to make sure that everything you can do this year, you're doing already, right?
Yeah.
That's right. That's right. You know, it's carpe diem. Tax plan now. Don't wait till the end. Start doing it now. Seize the day.
Right, because one of the things definitely I heard was that they're going to keep pension plans in place, 401k plans in place. They're going to keep capital gains in place. The only thing that I heard they were going to change was the standard deduction.
That's right.
And the tax brackets, which is not too much simplification as far as I can see. So the thing is, if you have a 401k plan at work, and this is the time to make sure that you enroll in your 401k. Now, you don't have to put in $20,000. You can start off small with $1,000, for instance, or $500. Whatever you put in, and if there's a company match, that means if you put in $1,000, the company may match $1,000. So if you don't if you don't get in there, you've really blown it.
Shot yourself in the foot, you
Shot
like to
yourself
say.
in the foot. That's exactly right. The other thing is, make sure that you change your W-4 at work one way or another. If you had a gigantic refund last year, we always say change your W-4 so you're not getting a gigantic refund at the end of the year. Those of you that are waiting for New York State and federal refunds, you're waiting because you gave them your money. And now they're making you wait while they make themselves comfortable that what you put on the tax return is what they agree with. So if you don't want that situation to be in the cards next year, change your W-4 at work so that you claim more allowances so there's a smaller refund.
That's what I've been telling to these people who have been calling and they're waiting for their New York refund. I'm like, now change your withholding so you're not in this position come next year.
Right. I mean, they can't hold up a refund they don't have.
That's right.
Right? So, and then some of you who had a big balance due the last few weeks, you need to change your W-4. You need to contact Social Security. You need to contact your pension department and have them start withholding.
Mm-hmm.
That's right. Cut that balance due. You know, there's people out, I don't mind writing them one big check. But you know what? That big check could have been a little bit smaller because they're penalizing you for writing one check instead of...
And then, Chris, you know, the other thing is, it's easy to say you don't mind writing one big check, provided you have the money to write the big check.
Right.
Yeah.
And you know, stuff happens. You thought you'd have the money, but then the washer broke down, the refrigerator broke. You got to have new tires, and the $1,000 you had set aside or $2,000 is gone. You know, and then you're between a rock and a hard place. Now you're penalized for not paying them, and you're tempted to not file the tax return. Those kind of things can be head off by changing your W-4. If you're on Social Security, if you're just starting Social Security this year, do you know that 85% of your Social Security can be taxable? So if you're getting $30,000, about $24,000 of it can be taxable next year, and that means that, an additional tax bill of $2,400 to $3,000. You can change that, so you can call them up and do a voluntary withholding. Correct?
That's right. That's right. It's called a W-4V. You can download the form. You can Google it and fill out the W-4V. There's a opportunity to do 7% withholdings, 10%, 15, as much as 25, Chris? For
7, 10, 15, and 25.
Yep, that's right. So you can do that. You have to hand it in to Social Security, and they'll start voluntarily taking out withholdings, which is a really good idea, I think.
Right, and just to have just to pre-plan for next year so that you don't shoot yourself in the foot. The other thing is planning for RMDs. If you're turning 70 and a half this year, then you are required to take out the money that's in a pension plan, IRA, 403B, 401K, that hasn't been withheld yet. And if you fail to do that, the penalty for failure to do that is 50% of the amount that you were supposed to take out. So nobody likes to think about this stuff, but you kind of have to do it.
That's right.
Right?
You got a plan.
Right. I'm Esther Golias, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on the cell phone. Okay, so let's talk about...
Ed has a question about RMD if you want to go to Ed. I don't know.
Sure. Hey, Ed, how can we help you?
I turned 70 and a half last year in September.
Okay.
And I only have $5,200 in the IRA. How much would I have to take out every month to meet the qualifications of?
Well, it doesn't have to be every month. You just have to take it out during the tax year of 2017. And so, in his situation, we're only talking about $200.
Yeah, $190 to be exact.
Yeah. So once you take out $190, you're good to go.
And I can spread it out all year long, right?
Yeah, but why not just walk in and say to the bank, "Hi, this is Ed. I'd like my $200 or my $190," and they'll give it to you and you're done. At least you can do something with it rather than $20 a month.
You don't have to spread it out all year long, Ed. You could take it all at once, Esther said.
Okay.
Yeah.
How do you figure it out?
Well, the first year you take what's in there. You said 5,000 or what, right around there, and you divide it by 27.4, and that gives you your yearly distribution.
Oh, divided by 27.
Yep.
Right. And just kind of piggybacking on what Ed is talking about, a lot of people think they have to take it monthly. You don't have to. You can do a lot more with it too if you take it out annually. Like if your RMD is 10,000 or 15,000, that might be a better way for you to take it out. That way you have a lump sum of money to do windows, to do roofing, things of that nature, so you can maybe help to start to remodel your kitchen. So you can do something good with the money rather than having it come in a little at a time and you have a tendency to maybe spend it.
All right.
Okay, Ed?
Thank you, Esther.
You're welcome, Ed. I'm Esther Golias, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on a cell phone.
Wait.
All right, why don't we talk right now the way taxes work?
Chris?
Yeah, I just, going back to Ed real fast. Sorry, Esther.
Right, Chris.
If, depending if his other income, if it's only $5,000 in there, he may want to just take it all out right now and put it in a regular bank account.
Oh, you mean the whole 5,000?
Yeah. So then he doesn't have to worry about the minimum district.
That's true.
You know.
All right, so let's back up for Ed or anyone else listening. If Ed is under, and that's why I wanted to talk about how taxes work right now. Ed's standard deduction right now, he's over the age of 70 and a half, so his standard deduction is $6,300 plus $1,500, so he's $7,800 plus $4,050. So he's about $12,000, $12,500, almost $13,000 before he pays any taxes. So if he has no other source of income except for Social Security, what Chris is saying is take out the whole $5,000 because none of it's going to be taxed. Then he doesn't have to worry about an RMD.
That's right.
Right?
And don't have to think about it every year. That's a really good idea.
Right? Good point. All right, so let's talk about how taxes work. And right now, we have a standard deduction, and the standard deduction is $6,300 for a single person, plus a little extra standard deduction if you're over the age of 65 and you're single, or $12,600 if you're married filing a joint return, plus a little larger standard deduction if you're over 65, both you and your spouse. Added to that, your personal exemptions of $4,050. So it sounds like they're going to get rid of they're proposing to get rid of the personal exemption as well. Did you catch that?
Did you? I didn't.
No,
catch
I was just
that.
going to say we didn't hear anything about that. So,
But they talked about getting rid of deductions and increasing the standard deduction. So if they make the standard deduction, which is now $12,600, and the personal exemptions of $8,000, it's almost exactly what they're talking about in increasing the standard
But
deduction.
where it would
so
hurt-
it's not really an increase at all.
A large family.
a large family
Would
Would
that
really
would
get
hurt.
shot in the
suffer.
foot.
Yep.
So right now we just are looking at a one-page explanation, and there's really nothing defined in this explanation. So right now, if you're somebody that has, like Ed, who is just on the phone, if he only has a Social Security and a small RMD, he can do his on a postcard right now too, right? The thing is, what are they really proposing? So if they're proposing to get rid of personal exemptions in exchange for a standard deduction, if you have 4 children or 5 children, you would have gotten a standard deduction, a personal exemption of $4,050 times 5.
That's right.
That's right.
And you would
yep.
possibly be losing that. Well, we got a break for news. I'm Esther Gulius, the tax lady. 8030930, 8030930, star 930 on your cell phone. We'll see you on the other side.
Just like the one-winged dove sings a song, sounds like she's singing. Ooh, ooh.
Stevie Nicks.
Stevie Nicks, right?
Yep. Yay. Frank is
Yay.
shaking his head.
Hey, boy, I'll tell you, we're not as bad as we think we are. We almost are as bad as we. At music, we are not so hot, right? Anyway, but we're very good at taxes. I'm Esther Gulius, the tax lady from EG Tax with Christopher Fabian and Tiffany Fabian, and we want to help you with your taxes. And if you're somebody that's thinking, gee, is this proposed change in the tax law good? I have to tell you, anytime there's a reduction in the tax rates, that's good. It was interesting, though. I was talking to my husband, and I said, it's interesting. It's like they have been concentrating on business, which is obviously so important to have a cut in business. But when I looked at what they're proposing for individuals, I didn't see that same thing, because really the bottom rate right now is 10%.
Right,
Yeah.
right.
And they're proposing the bottom rate be 15%.
That doesn't sound good.
So, anyway, but the thing is, we want to tell everybody, if you're wondering, believe me, as soon as we get this thing sorted out, if we get any details, we will certainly let you know. The important thing is watch out what you're listening to. If you don't understand, you can call EG Tax. We're very happy to clarify everything. Remember, it has to pass the House, the
That's
Senate,
what I was going to say.
and it has to be signed by the president. So that's the other thing. And then listen to, and don't listen to the hype on TV. Know what you're talking about.
You keep on saying, you keep saying to Chris and I that there's a long way for it to go, and there's this is just the beginning of their fighting and their commingling.
And the other thing is, they're talking about adding stuff for child and dependent care, which makes it more complicated. So I think that we have a very, 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 very complicated tax structure, and so it'll be interesting to see how they can unravel it. But I'm just going to tell you, going from 6 brackets down to 3 and increasing the standard deduction is not really simplification. Not really.
No, not at all. Not at all. There's so much other stuff in there.
But the cool thing is the 15% tax rate, if they are able to get that on corporations, that's wonderful. I mean, that's a wonderful thing, because right now, in order for us to be competitive across the United States, obviously a lower tax rate is good. I just don't know how they're going to pay for stuff. I think they're thinking they're going to stimulate everything, but it'll be very interesting to see how they are able to balance it.
Yeah, well, hopefully it will mean people, especially because with the hourly rates keep going up, people are going to have to start laying off in order to keep their companies going afloat, and so hopefully this would mean
that's especially New York State. I mean, New
Yep.
York State is the big minimum wage increaser. Other states don't have that problem. I mean, they don't. They just have the federal minimum wage is not like what New York State minimum wage is.
Yeah, because let's face it, the tax code is the revenue stream. It's a large part of the revenue stream, and so they have to keep that stream going.
And
in
then
order
that's
to...
the other thing. New York State, to believe that New York State is going to follow suit with the federal is very interesting, because I don't think New York State is looking for a gigantic tax cut.
No.
I think probably the opposite is true.
Right.
So, because we have to pay for this free education. So it'll be very, very interesting. And, of course, we're going to keep everybody abreast. Hey, why don't we go back to Dave? And, again, 8030930, 8030930, star 930 on a cell phone. David, what can we do for you, sir?
I was asking a lot of the questions that you guys have already answered for me. To be quite honest with you, I make a decent dollar, and I just want to know the ramifications of these things. And it seems like nobody knows the answers right now, which is...
It's been it's a one-page memo. It's not very, very detailed at all. But what I did glean was that cap gains are still in. AMT is gone. So if you make a lot of money or a pretty good dollar, alternative minimum tax was something that was a potential nemesis against you. That is going to be eliminated. If you're at the top at the 39.6% bracket with the other caveat, the 2-point-some% that they would charge you because you made too much money, that'll be eliminated. So it looks like you could be down as much as 5 or 6% at the top.
Really?
Yeah, and then the maximum, the other thing I read was that the maximum itemized deductions are going to be $100,000, but they're eliminating property taxes,
Medical.
sales taxes, medical, and
job expenses.
Yeah, and employee business expenses. So the only two things that would be an itemized deduction would be in mortgage interest and investment interest and charitable giving. So that's part of the proposal too.
Yeah, the other question I want to ask you now, this is happening in the middle of the year. Now, does that mean all the exemption, all the expenses that you've incurred for your properties and things of that nature that you would write off? When would it be? When does this gavel fall? And how does...
Well, first, it's really such a good question, Dave, because they have to either make it retroactive back to January of 2017, or make it the beginning of 2018 or 2019, or a phase-in, much like what they did with Obamacare, a phase-in over the next couple years. So I don't think that no matter, even if they pass this thing in August, I don't think they can roll it out in time for 2018. So I think that's why we're saying to everybody, make sure you got this year squared away so that you can be ready for whatever's going to roll out in 18 or 19.
Right. So we're in a big question mark right now.
Right, that's right. And I have to tell you, I think from what I saw, I think they're in a question mark. I'm not sure that they know what they want to do.
Well, I think they do, but what it is they want to give back as much money to the people. They're thinking it's going to stimulate the economy.
Right, and that's where I think the reduction in the tax rates are coming in.
Right. But then you got so much political and all the other stuff.
And that's interesting, because you have the Republicans that are very, very conservative who don't want the budget deficit to go any higher, and so they're fighting. The worst thing is the Republicans are fighting against the Republicans.
Yeah. Right. We could go on and on and on.
We certainly could. But hey, thanks for calling, Dave.
Have a great day, guys.
You too. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. So we kind of went over what the proposal is, that the itemized deduction would not only just have two categories.
Right, but which also means that one big thing that is eliminated, especially for the seniors, is gambling losses.
Oh, God.
Could you imagine these people who come in and say they won $75,000 in a casino over the year and they can't write off their losses? That's not saving them any money.
And this is part of what's going to happen in Congress when these bills go before before the House and Senate, people are going to debate this and say, and how about the earned income credit? Nobody's talking about the earned income credit, or
That's what
the
you
child
said.
tax credit, or the additional child tax credit, or the alternative. I mean the American Opportunity Tax Credit. All those things nobody mentioned.
That's what
Nobody
you,
mentioned.
you said that earlier in the week, those are huge credits, and those are or stimulus and things. They're sort of like social programs, and they get people back to work, and that's so vital and so key, and so many people count on those and use it every year, and there should be lots of conversation on that topic.
Right, and then they're looking at the new child care credit, and I know that they're trying to make that far more beneficial to parents who are paying the gigantic daycare expenses. So it'll be very interesting. But basically what they're looking at is a increased standard deduction, right, up to $24,000 if you're married filing a joint return. And it looks like they're going to eliminate they're looking at eliminating the alternative minimum tax, eliminating estate taxes, and dropping the tax rate on small businesses to 15% maximum. So that looks like the big part of the proposal.
And what did you say? There's going to be 2 categories for itemized deductions that you can read so far,
just
Esther?
just charity and interest.
Wow.
Just charity, and the maximum, from what I saw, was $100,000. Maximum itemized deduction is $100,000, which would be quite a big interest if you're paying that, because right now the tax law says that you're not allowed to take mortgage interest if your mortgage was over $1 million. So
Right.
you can only take it on the first million. So I'm Esther Gilius, the tax lady from EG Tax, 803-0930. 803-0930, star 930 on a cell phone. Again, they're saying that capital gains will still be in there. They're looking at the maximum at 20%, which looks like they're going to keep capital gains the same. What else is not so good? It eliminates the tax deductions for New Yorkers who pay high property taxes, high sales taxes,
That's
and
right.
high income taxes.
That's exactly right. That would be, I mean, when I do somebody's tax returns, I get this opportunity to pry into their world and look at how much people pay in property taxes, and we pay a lot in county, municipality, school, and it's just a lot of money that we wouldn't be able to take advantage of.
That's exactly right. Again, and let's face it, Obamacare is in the tax code.
Yeah.
So that's another thing that they have to reconcile, what to do with Obamacare in the tax code, because right now it's just like we were talking about at the top of the show, there are people that are getting letters because they haven't reconciled the 1095A form with their subsidy against their tax return. That's still in the law, and until they reconcile that, that's still going to be in the tax law.
Yeah, and it would also be sad to not have sales tax around, too. That was always an option for senior people who didn't pay state income taxes, that they could do sales tax, and so I guess that wouldn't be an option for any of us anymore if this provision goes through.
All right, so we're going to tell you things that you should be thinking about after the break. 803-0930. 803-0930, star 930 on a cell phone. Should you start moving your money from a traditional to a Roth? Is now the time to do it? We'll talk to you after the break. Hey, I'm Esther Gilius, the tax lady from EG Tax, and believe me, taxes are in the news, and we want to keep you up to date on the ever-changing tax law situation. Just when you think you got it down, then they go ahead and change it again. And then I said to somebody the other day, and then watch in the midterms if the Democrats get back in, and then they change it all back again. You know, it's just like,
I feel like it's this big pendulum that goes back and forth, back and forth.
Right. That's
Yeah.
true. Anyway, we want to talk to you about your taxes. 803-0930, 803-0930, star 930 on a cell phone. And you know, those of you that are regular listeners, you hear me say a Roth may not be the best thing for you. And I'm going to tell you something. Don't make any big decisions this year until you You absolutely have to until you see what's coming down the pike. For instance, if you are somebody that wants to do a traditional to Roth conversion, maybe you got $100,000 in your traditional IRA and you want to move it to a Roth, and you're thinking of doing it this year, and you're in the 25% bracket. Next year, the bracket could be 15%. So you would have shot yourself in the foot by $10,000. So don't do anything big until you know what the new tax law is going to be. And it looks like we certainly have 7 or 8 months to sit around and wait and see what they're going to do.
That's right. That's right. Because, like you said earlier, by the time it gets through all this proper channels and it finally gets approved, hopefully we'll have all the answers for everybody.
Yeah, I mean, we had somebody the other day was saying that, he thinks he wants to take all of his money out of his pension plan because he doesn't want there to be an obligation for his children upon his death. We're going to pay taxes. Well, the thing is, right now, if he does it right now, he would pay 25%. It was a substantial amount of money, like $200,000, 25-30%. So you say to yourself, you're going to pay all this money up front, $60,000. Why don't you wait? They may completely change how you withdraw it, what's going to be taxable. Maybe you can roll it over. You don't know what's going to happen when they start really debating tax law. So sit and watch and wait, and I will tell you, listen to Ask the Tax Lady, because we will keep you abreast of the ever-changing world of taxes. Right?
It's funny, you said before Trump was nominated, you said one of the things is the Republicans wanted to make changes to the tax code, and so you saw this coming. You told us of it coming, and this happens, and so.
Well, I think everybody they really wanted to. The Republicans want to stimulate the economy, and the best. And I can remember, unfortunately, all the way back to Reagan, when the Economic Recovery Act went into place, and they put all of this accelerated depreciation, and people went nuts. Mm-hmm. They said, "Let's see if I buy 10 rental properties, I don't pay income tax." So people bought 10 rental properties.
Right.
People that never would have in the first place. So stimulating the economy this way is very good. But we're basically at the gate of a horse race, and they haven't even rung the bell yet.
That's right.
So we're going to let people know. Okay, we got Carol that's been waiting. Hey, Carol, how can we help you, my dear?
I was just wondering if you could comment on, because the way I see it, the tax was supposed to help the middle class and the low-income people, and the only people that I see the proposals are going to help the wealthy.
Can I say something, Esther? Before I walked into the studio, Mike Lomas, who has the show before us, he walked out and he said, "Oh my God, everything I hear so far is this is not going to help me. It's going to help the middle class and the lower income." So, Carol, what we're hearing is contrary to what you just said.
Yes.
Well, here's the thing.
Contrary.
The thing is, Carol, if the standard deduction for a married couple is $24,000, that has just eliminated thousands and thousands and thousands of people from filing tax returns and paying taxes. So that benefits lower income people, not lower class, lower income people.
You're a single person and not married.
Well, I think they're looking at a standard deduction of like $12,000 or $14,000. So again, that would eliminate a lot of the lower income people from paying taxes at all. What people don't realize, though, is there's credits in the law. There are earned income credits where people that have children, up to 3 children, can get refunds on the state of New York and federal of like $9,000 of money they didn't pay in. These same people can get $1,000 per child for children under the age of 17 as a refundable credit as well. So some people in New York State, for instance, are getting $12,000, $13,000, $14,000 in refundable credits. Now those people, if they just cut the tax rates, that they're going to end up not being very happy. So this is why nobody mentioned credits.
It depends on if you have children. I mean, if they're taking the a 35% bracket and dropping it down to, what was it, 20 or something like that, they're getting a 15% break, the wealthy. But if they somebody that was already in the 20% bracket,
it's going down to 15.
Still stuck in it, still not getting anywhere.
Well, but you have to you have to factor in, if your standard deduction was $6,300 and now it's going to be $12,000, it's like they've said you didn't make $6,000.
Yeah.
So that's good, but I will tell you again, if they don't do something with these refundable credits, a lot of people are going to be very unhappy. I can't picture that they can, at this point in time, I don't see how they can eliminate the earned income credit.
Right. Plus, we don't even know where the new income levels are going to be. So we're all just guessing. No one has
That's
crystal
true.
balls. No one has magic 8 balls to say, does it start at the $18,000 level or the 48? We don't know. So for Carol, no one knows what the tax brackets are going to
And
lay.
nobody even talked about personal exemptions, so we don't even know if there is a personal exemption under this proposal. But we will find out, and we will let you know. Okay, Carol?
Thank you.
Thank you, sweetie. Yeah, and that's really, I've been scouring the internet and looking at everything that I can, but again, it's pretty much mute on any details.
Right.
And so
because
until they
there's
start,
no details.
That's true. So, all right. So let's help people about right now. In 2016, the 2016 return, if you're somebody that's getting letters, who helps them?
We do. We love to help them and set your mind at ease. And it's just come in, call our office, 632-7886, and we'll get you an answer.
And we help you, and there's no charge for us to help you with a letter. If when we see the letter we find out that you messed up your tax return, we will offer to correct it, and we do charge to correct it. But if you want to go home and have Aunt Sally do it, that's okay.
I got a good example. I was helping a client who's our client the other day. He forgot some 1099 INT, and his daughter brought him in because he was grieving, and she did her return on Tax Act, and she received money from her mom who had passed away, and it was a death benefit. Her mom was over the age of 59 and a half, and I said to her, so did you back off the $10,000 since you were the only beneficiary of your mom's money on New York State? No, I didn't do that. And then so she made an appointment with me, and we amended her federal too because she only made $20,000. She works at a counter, and we amended her federal return because Tax Act charged her a penalty for not having health insurance. So my point is review the returns that you did on these softwares, because you only have 3 years to make changes, and don't give them, the tax agencies, more money than you have
Okay, so
to.
let me just interpret what Tiff was saying, is that there are exceptions to penalty, and if you're somebody that didn't have health insurance and your income was relatively low, there's an exception to penalty. So if your software charged you a penalty for failure to have health insurance, we may be able to, and often do, get that penalty reversed because there's an exception to penalty. Again, our whole thing is seize the day. Monday will be a week from tax time. I mean, or 2 weeks from tax time, tax deadline time. And while it's still fresh in your mind, and those tax returns you haven't put away yet, come in and make an appointment. Let's review it for you and put your mind at ease to make sure that you did not overpay your taxes last year on federal or state.
And then I talked to another person over the phone, and he uses the tax software, and he adopted some kids, and they weren't giving him the adoption credit, so he came into our office on Friday, and Tim helped him, and he amended his prior year, and he fixed this year.
That's a little mistake. Only $13,850,
Yeah,
right?
that's right.
I mean, when you have children that you adopt, even if you didn't pay for the adoption, if there's special needs adoption, you get a credit of like almost $14,000, and we're not talking deduction. We're talking money in your pocket. So that is one heck of a big mistake.
And that's the one thing. The government, they'll send you letters when it's in their favor. Mm-hmm. They'll say, "Dear Esther Gulius, you made a mistake on your return. You owe us money." They'll never send the letter, "Dear Esther Gulius,
you missed
a $13,000 deduction."
Right. You have a new child on your return. Gee. And it has a different last name. Could this be an adoption? And it's interesting with software. I know that that's something that is within the realm of reason, but I think because we have a voluntary income tax situation, it's not up to them to point it out. It's up to us to point it out to them.
Correct.
Right?
Yep.
So if you haven't filed, if you'd like a review, if you're getting a letter, if you have a big balance due, we can help you. We have attorneys on staff that'll help you to do an offer and compromise. All you have to do is call our office, and we'll help you to hopefully eliminate or get that debt down to something that you can whittle away. Or if you haven't set up a payment program, we'll help you to call the state and federal to set up a payment program. I mean, the whole thing is we're like your one-stop shop helper, tax helper, right?
Yep.
We sure are.
We certainly want to help you, that's for sure. But I will tell you, and if during the week you have questions, or maybe you're at a dinner party and you think, oh, I don't know about this, and people are having a fight, go to egtax.com, because you can go right on that website and go to Ask the Tax Lady. That comes right to me, and I answer the questions wherever I am. I could be floating around on a raft in a pool, and I will answer the question. You know, the thing is, my phone does get wet, though, right? Until next week, I'm Esther Golias, the Tax Lady from EG Tax. I got Chris Fabian and Tiffany Fabian here as my loyal compadres. During the week, we want to help you. Thanks for listening. We'll see you next week. Bye-bye.